The company that invented the robotic vacuum didn't just go bankrupt. They were literally eaten alive by the very factory they hired to build their machines. I need you to understand that what happened to iRobot on December 14, 2025 is not just a standard bankruptcy filing where a company reorganizes and tries again. This is an extinction event. If you are holding shares of IRBT, the ticker symbol for iRobot, those shares are effectively heading for zero. And the company, as we know it, the great American pioneer of consumer robotics, has officially entered the terminal phase of its existence. But to really grasp the magnitude of this collapse, we have to look beyond the headlines. Most people see a bankruptcy and think it's just about running out of cash, but the forensic data here paints a much darker picture. This is a story about a company that committed a slow, strategic suicide by handing over its intellectual property to its supplier, refusing to update its technology because of arrogance, and then trapping retail investors in a financial death spiral that was mathematically impossible to escape. We are going to perform a full autopsy on this collapse because it is a perfect, terrifying example of the innovator's dilemma combined with what I can only describe as financial toxicity. Let's start with the immediate situation so we are all on the same page. On December 14, iRobot filed for Chapter 11 bankruptcy protection. But this filing contained a specific, brutal detail that many retail investors missed or simply didn't want to believe. They entered into a restructuring support agreement, or RSA, with their primary lender. And who was that lender? It was Passia Robotics. This is crucial. Passia was originally just the contract manufacturer based in Shenzhen, China, that iRobot hired to build their vacuums. Over the last few years, iRobot outsourced more and more of its manufacturing to Passia to save money. They thought they were being smart, cutting costs by $80 to $100 million a year. But what they were actually doing was teaching Passia exactly how to run their business. They gave Passia the blueprints, the supply chain logistics, and the engineering know-how. And eventually, when iRobot got into financial trouble, Passia didn't just stay a manufacturer, they bought iRobot's debt. So the company that built the robots became the company that owned the mortgage on the house. And in this bankruptcy deal, Passia is converting that debt into 100% equity ownership. That means Passia takes the company private. They take the brand, they take the technology, and the current shareholders get wiped out. Zero recovery. It is a complete transfer of assets from the American innovators to the Shenzhen manufacturers, and the public equity holders are left holding nothing but a bag of air. Now, you might be wondering, how did a company that literally invented the category? I mean, Roomba is the clinics of robot vacuums. How did they fall this far? To understand that, we have to look at the technology, because this wasn't just a financial failure, it was a product failure driven by stubbornness. For nearly 2 decades, iRobot dominated the market. They had a fortress of patents. They had over 900 patents worldwide, covering everything from the way the brushes spin to how the robot docks. They spent millions of dollars suing competitors like Shark Ninja and Bissell to keep them off the shelves. They thought this patent moat would protect them forever. But while they were busy in the courtroom, they stopped innovating in the living room. The biggest technological fatal flaw was navigation. If you've ever owned a Roomba, you know it uses a camera-based system called V-Slam. The robot basically looks up at your ceiling, takes pictures of landmarks like corners and lights, and tries to figure out where it is. It's like trying to navigate a new city by looking only at the tops of skyscrapers. It works okay, but it needs light. If you run a Roomba in the dark, it gets confused. It bumps into things. It takes a long time to map a room because it has to physically drive around and bump into walls to find the boundaries. Meanwhile, the competition, specifically Chinese companies like Roborock, Dream, and Ecovacs, pivoted to something called LiDAR. If you look at those robots, they have a little turret on top that spins around. That's a laser scanner. It shoots out invisible laser beams thousands of times a second to measure distance. The difference in performance is night and day. A LiDAR robot can map your entire house in minutes without even touching the walls. It can see in pitch-black darkness. It updates the map in real time. It is objectively superior technology. But iRobot refused to switch. They insisted that cameras were the future because cameras could see objects like shoes or cords. They spent years and millions of dollars trying to make VSLAM work as well as LiDAR, but they never caught up. While iRobot was trying to optimize an inferior navigation system, the market moved on. Consumers realized they could buy a Roborock that cleaned faster, didn't get lost in the dark, and mapped their home instantly, often for the same price or less. iRobot was fighting a war with muskets, while the competition had laser-guided rifles. And then there was the poopcalypse. We have to talk about this because it destroyed the brand's premium reputation. iRobot marketed a feature called the POOP promise, Pet Owner Official Promise. They claimed their AI was so smart it would identify and avoid pet waste. It was a massive marketing campaign. But then the reality set in. Social media, especially Reddit, started filling up with horror stories. Verified users reported that their $1,000 flagship J9 Plus robots were failing to identify pet waste. The robots would run over the mess and then proceed to smear the mess across the entire house. Hardwood floors, expensive rugs, everywhere. It became a meme. You had a premium brand charging top dollar for a machine that could literally ruin your home in an afternoon. When you combine a technology deficit, the lack of LiDAR, with a catastrophic failure in core reliability, like the poop incidents, you lose the trust of your most loyal customers. And that's exactly what happened. Revenue started to free fall. In the third quarter of 2025 alone, revenue dropped nearly 25%. In the US, their home market, it dropped 33%. That is a collapse. But here is where the story shifts from a business failure to a financial tragedy for investors. Because as the business was crumbling, the management team and the financial structure of the company created a trap that destroyed whatever value was left. We ran a forensic analysis on iRobot using an 18-point red flag framework, and the results were terrifying. Out of 18 possible red flags for a distressed company, iRobot triggered every single one. It scored an 18 out of 18. This wasn't just a sinking ship, it was a ship that was on fire, taking water, and being looted by the crew at the same time. One of the most dangerous mechanisms they used was something called a shelf offering, specifically combined with an ATM program. No, not a cash machine. ATM stands for At the Market Offering. Imagine you own a rare baseball card, and you put it up for auction, and you get the best price. That's a normal sale. An ATM offering is different. It allows the company to secretly print new shares of stock and sell them directly into the stock market during the trading day, little by little. It's like a slow leak in a tire. Throughout 2024 and 2025, as iRobot burned through cash, they used this ATM machine to relentlessly dump new shares onto the market. Every time the stock price tried to rally, maybe there was a rumor about a new product or some optimism about tariffs, the company used that buying pressure to sell more stock. They were diluting the existing shareholders to pay the bills. This acts as a silent killer for the stock price. It creates a permanent ceiling. The stock can't go up because there's a permanent seller, the company itself, unloading inventory. They raised nearly $20 million this way, but it wasn't enough. They were burning over $11 million a month. The ATM was just keeping the lights on for a few more weeks. When the ATM stopped working because the stock price got too low and they lost regulatory eligibility, they turned to something even more toxic, the death spiral. To get emergency funding from their lenders, specifically the Carlyle Group, iRobot issued warrants. A warrant is the right to buy stock at a certain price. But these weren't normal warrants. They were penny warrants. They gave the lenders the right to buy 5% of the company for a strike price of 1 cent. Think about the incentives there. If a powerful lender owns the right to buy millions of shares for a penny, do they care if the stock is at $5 or $4? No. In fact, they're incentivized to short the stock, to bet against it, because they have a guaranteed way to cover their position for basically free. This created a massive overhang of shadow equity. It signaled to the entire financial world that iRobot was desperate. You don't give away your company for a penny a share unless you have zero other options. And while all this was happening, what were the insiders doing? This is always the most telling clue. If a company is about to turn around, if the bankruptcy rumors are false, you'll see the CEO, the CFO, the directors buying stock with their own money. It's the ultimate vote of confidence. At iRobot, silence. Zero open market buying. In fact, we saw the opposite. We saw the CEO, Gary Cohn, disposing of shares to cover taxes. Now, executives will tell you that selling to cover taxes is standard procedure, and it is. But if you truly believe your stock is undervalued at $3, you don't sell shares to pay the tax, you write a check for the cash, pay the tax, and keep the shares, because you think they'll be worth $10 someday. The fact that the CEO chose to give up shares rather than cash tells you exactly what he thought those shares were worth. He knew. The management team knew the liquidity crisis was terminal. They were preparing for the end while retail investors were still hoping for a miracle. This brings us to one of the cruelest parts of this collapse, the zombie squeeze. Just days before the bankruptcy filing, around December 10th, 2025, iRobot stock suddenly exploded. It jumped 48% in a single day. The volume was insane. 129 million shares traded in one day. The company only has about 30 million shares total. That means the entire company changed hands 4 times in a single trading session. Retail investors saw this and thought, this is it. Someone knows something. Maybe Amazon is coming back to buy them. Maybe a white knight investor is saving the day. They piled in. They bought calls. They chased the momentum. But looking at the forensic data, this wasn't a rescue. It was a trap, a classic rug pull. Here's what likely happened. The short interest in iRobot was massive. About 40% of the float was sold short. Sophisticated short sellers likely got wind that the bankruptcy filing was coming that weekend. So what do? They buy stock to cover their shorts and lock in their profits before the stock is halted. That buying pressure drives the price up temporarily. At the same time, high-frequency trading algorithms saw the volume and started churning the stock, creating a fake sense of demand. This lured in the retail traders. The smart money was using that liquidity to exit their positions and hand the bag to unsuspecting investors. 4 days later, the company filed for Chapter 11 and the stock crashed to near zero. Anyone who bought that rally lost everything. So, where does that leave us now? What is the actual state of play for iRobot? The company is currently in what we call a free-fall bankruptcy. The debt holders, led by Passia, are in total control. They have over $350 million in claims against the company. iRobot has less than $25 million in cash. The math is simple and brutal. The debts are larger than the assets. In a bankruptcy court, that means the equity holders, the people who own the stock, are last in line. And when the line is this long and the money is this short, the people at the back get nothing. The plan is for Passia to take the company private. They will own the Roomba brand. They will own the patents. They will own the customer data, which, by the way, raises a massive privacy concern. Passia is a Chinese firm. They will now technically own the detailed maps of millions of American homes that Roombas have been collecting for years. That's a geopolitical angle that hasn't even fully played out yet. But for the stock, it's over. The ticker IRBT will likely be delisted from the NASDAQ. It will drift down to the pink sheets or the OTC market. Liquidity will dry up. Your brokerage might not even let you sell the shares. Eventually, when the restructuring plan is approved by the court, the old shares will be canceled. They will simply cease to exist. This brings us to the final painful lesson of the iRobot story. It is a warning about the difference between a brand and a business. We all knew Roomba. It was an icon. It was a piece of the future that we lived with. But a famous brand does not protect you from bad unit economics. It does not protect you from arrogance. And it certainly does not protect you from a balance sheet loaded with toxic debt. iRobot fell into the classic trap of the innovator's dilemma. They were so busy protecting their old success, their V-SLAM cameras, their patents, their legacy, that they missed the shift to the new standard of LiDAR. They let competitors like Roborock steal the premium market with better tech, and they let Shark Ninja steal the budget market with better pricing. Then, in a desperate attempt to fix their margins, they outsourced their soul to Passia. They fed the tiger that eventually ate them. If you are a speculator looking at this stock now, thinking about buying the dip because it's iRobot, it can't go to zero, stop. Look at the red flag report. Look at the debt structure. This is not a dip. It is a liquidation. The zombie squeeze you might see in the next few days is just the nervous system twitching after death. The iRobot you knew is gone. The name will survive on a sticker slapped onto a robot made in Shenzhen, owned by a company in Shenzhen, profiting a company in Shenzhen. The American pioneer didn't just lose the race, they sold the track to the competition and then crashed the car. For investors, the verdict is clear: avoid. For students of business, the lesson is etched in stone: adapt or die, and never, ever teach your supplier how to do your job better than you can. And hey, I hope this video helps you on your quest for profits. Catch you on the next one.